In this video, we will explore about the selection criteria of index for trading. You can think of this as a complete guide to understanding how financial markets decide which indices are suitable for advanced trading tools like derivatives. To start, let us look at the basic eligibility rules that an index must meet. For an exchange to offer trading on an index, the stocks making up that index must be reliable. Specifically, the stocks that are already allowed to be traded as derivatives must represent at least 80% of the total weight of that index. Additionally, we must ensure that no single stock that is ineligible for individual trading holds more than 5% weight within that index. The exchange does not just check these rules once, they perform a monthly check to ensure everything is still on track. If an index fails to meet these requirements for 3 consecutive months, we see some important consequences. First, the exchange will stop issuing any fresh or new contracts for that index. However, if you already have an existing trade, you are permitted to continue trading those unexpired contracts until they reach their expiry date. Now, we need to talk about something called the product success framework, which is applied to almost all index derivatives. This framework helps evaluate how well a trading product is performing at its core level. We should note there is one major exception. This framework does not apply to the flagship indices of the exchanges, which are the main well-known ones. To evaluate all others, we use 4 specific metrics to measure their success. The first 2 metrics focus on who is trading and how often they do it. We look for member participation, which means either 15% of the active trading members or at least 20 trading members, whichever number is lower, must have traded that index in every month being reviewed. We also look at trading frequency, where trading must have occurred on at least 75% of the total trading days during that period. The next 2 metrics are all about the money and the volume of the trades. During the review period, the index must have an average daily turnover of at least 10 crore rupees. Along with this, it must maintain an average daily open interest of at least 4 crore rupees. These numbers ensure there is enough money and active interest in the market to keep trading smooth for everyone. If an index fails these tests and is excluded from the list, we follow a strict cooling off period. It cannot be re-included for at least 6 months. If an exchange wants to relaunch contracts on that index after this time, they must make suitable modifications to the contract rules based on what the market says. Most importantly, any relaunch is always subject to approval from the market regulator, SEBI. Sometimes, an index under review might not meet all these rules, and that is where a surrogate or pseudo index comes in. You can think of this as a backup or an alternative index. If the primary index is struggling to meet the criteria, the exchange might look for a very similar index on another exchange that actually does pass all the tests. The main purpose of using this surrogate is to keep the market moving. If the original index fails the review process, we check if a surrogate exists elsewhere that meets the necessary criteria. If the answer is yes, the exchange may still allow trading on that original index because the surrogate acts as a reliable point of reference. However, there are very strict conditions for an index to qualify as a surrogate. First, we look at the constituent count, meaning the smaller surrogate index must have at least 80% as many stocks as the larger index. We also look for stock overlap, where at least 50% of the stocks found in the larger index must also be present in the smaller surrogate index. We also have to make sure the 2 indices move in a very similar way by checking their correlation. The correlation between them must be at least 0.90. This is calculated on a rolling basis over the previous 6 months to ensure they are consistently following the same price patterns. Finally, we must remember that there is a strict limit on how many of these backups we can use. An index on one exchange is only permitted to have exactly one pseudo or surrogate index per exchange. This keeps the system simple and prevents any confusion in the market.